A key man policy is he owns a transmission shop down in Florida, Naples, Florida, actually. And so he's the key man, right? Mm-hmm. So if he dies, that business is in bad shape. So what you do is you write a policy on the key guy.
Okay.
And if you make the company the owner and the company the beneficiary, then the premiums are tax deductible. That's the only time that the life insurance premiums are tax deductible.
Okay, on the business side. Okay.
Yeah. Key man policies are really good. Able to do any plumbing work. If you have a critical person in the company that would make the company cease to exist or stop the company, then you can put a policy on that. The company can put a policy on that person. I put one on each one of them. So you can have more than one key man in the company. The owner is the insured or the spouse or something like that. So in this case, the owner is the company. There's another kind of insurance you can do that's not a key man, that goes through a business that is not tax deductible. And that's a buy-sell agreement. And buy-sell is when, let's say you have two partners. You have two partners, and let's say we'll say it's like this surveying company, okay? And they have two licenses. Some of them technically licensed or trained or something, okay? Well, if this guy dies, his wife can't come and take over because she's not licensed and trained.
Right.
So a buy-sell is that money would go to the partner, the surviving partner.
Okay.
That surviving partner would use the money, either hire someone to replace him. Use that money to pay the wife to buy the second half of the business.
To buy it out. Okay.
So that they can hire somebody else to replace him. And because you don't want the wife, because if you didn't have it, he owns half the business, right? If he dies, well, his wife is going to inherit everything he had, which would be half the business, right?
Right.
She doesn't know how to run a transmission shop.
She would have to hire people to do it.
Well, he doesn't want the wife as his partner.
Oh, okay.
Right?
Right.
So that's what the life insurance money is for, to get her out of the way.
Get her out of the way, buy her out.
The electronic app, you cannot put submit if you forgot them.
And you can't make a mistake.
And I love that.
The corporate account is all paper, but it has boxes all over it. So this way, when you do something electronically, it won't let you miss a box. Now, can you put in something incorrect? Yes, absolutely you can. Like a social security number, date of birth, whatever, you can put them incorrect. But as far as not completing the application, you won't do that. This here is, how do I get this over? This is Primerica Online. This is what you'll have access to. POL. Primerica Online. On here is everything. This is what you pay the $25 a month for. Okay, what? This is what you pay the $25 a month for. Primerica Online. This gives you access to everything to run your business. Okay. If you have any question about anything, it's on here. Okay, so here we are, POL. Right here. See right here it says Turbo Apps. This is what you're going to click on if you want to do a life insurance quote. On Turbo Apps, you got several choices of what you can do. IBA is a application for somebody to come work with us. Policy change form is you're adding a child rider. We can go life app. Quote. Quick quote. Now we can use the old quick quote, which I'm not going to use, or the new quick quote 3.0. It's the new quote.
Okay, what is it?
So I got you at 5777.
Okay, 48.
So we go here and continue.
Oops. Okay.
Okay. So these are for the state of Georgia. You're a non-tobacco user. So if you weren't, we'd use it that. But in this case, you're a non-tobacco user. We have two kinds of coverage: power term and precision term. Okay. What are the differences? The power term, if I write a power term app on you for $250,000 right now, when I click done, the policy is issued in 2 minutes. That's fine.
Wow.
Okay.
That's power term.
Yes, power term.
We're talking, let's make it $500,000.
I can't make it.
Policy. or 55-year-old person, a power term, what's the length of that term?
Well, okay, we're gonna go down there, we're going down
Get
there.
ahead of myself.
Yeah, I'm showing you each piece to go down to where we're going. I do have a method in my madness. Okay, so, what I'm trying to teach you right here is there's two types of term. Power term and precision term. Power term, when I submit the application, in 2 minutes, the policy is issued. Okay, so, but look at the difference. So this is, on power term, the premium is $77.71.
Per month.
Because there was no, and this is on a 10-year policy, because there was no underwriting done. It was done all electronically. So I normally do precision term, which is $53.13 a month, which is what we're all used to doing. We're used to doing blood and urine and all that other stuff, right?
Power term was 77, we're going to precision term, and it's 55.
53.
Three,
There you go.
53.13.
53.
Right.
But both of them are 10-year policies.
Yep. I can't even think of the last time I saw an insurance client that did not also invest with me. But a lot of primary care agents, all they're doing is selling life insurance. And they'll sell this power term instead because they don't have to go back and get the client to get blood and urine and all this other stuff. So the policy gets issued because a lot of people in different markets don't want to go get the blood and urine done. So if they don't want to avoid, if the client, let's say I have a client, let's say you have a client that is definitely allergic to needles, does not want to do blood and urine. This is the way to get around it.
They'll issue it with no?
No, because how they do it is they go back and look through all their medical records. When you go click on power term, they pulled up all their medical records within 10 seconds. A lot of clients out there that don't want life insurance, that do want life insurance, that don't want to do the blood and urine part. So if the question is whether they get coverage or not get coverage, the only thing keeping them from getting the coverage is doing the blood and urine or not blood and urine, then that's what you do. I can send you a 10-year, a 15-year, a 20, a 25-year, or a 30-year policy. Okay. Okay. Now, what determines my choice and what I'm going to show you is going to depend on what answers you give me when I ask you some questions. If I ask you, how old is your youngest child? How's your youngest child? Michelle? 11. Okay, so her youngest child is 11 years old. In 10 years, that child will be 21 years old. And nowadays, 21 is not grown.
No.
35, 40. But it ain't anymore. So 25, when they're out of college, is closer. So the shortest amount of time she needs coverage is for 15. But she has another child, how old is Scott?
17.
He's 17. In 10 years, he'll be 27, right? So let's say she needs $500,000 of coverage. Okay. So what I would do is I would say, okay, I'm going to put $250,000 of coverage on her for 15 years, and then I'm going to add plan. I'm going to click here. I'm going to add a 10-year policy for $250,000. So now she has a total of $500,000 of coverage. Okay. So in 10 years,
Still one premium, right?
one premium right here, $95.22. But in 10 years, this policy will come up for renewal.
Okay.
And we're going to choose not to renew it. But again, my objective is for her to not need any life insurance in 15 years.
That's the objective. Okay.
That's what I'm trying to get her through. So for $250,000 of coverage on her for 15 years is $74.81 a month.
Okay.
But I'm going to add, but she needs $500,000 coverage.
10 years.
So, and for only 10 years. Now she's paying for $20 more a month. She gets another $250,000 in coverage.
Okay.
So in 10 years, I'll say, well, Your youngest child's grown out of the house.
You don't need it.
You don't need that. Now you have $250,000 in your investment accounts.
Mhm.
So you completely don't need that 250. So we're gonna take you down to 250, keep you at 250. Now your premium won't be 95, it's gonna be 74.
4, okay.
And then 10 years, 5 years after that, the other child's grown and gone.
Mhm.
Her money's grown again to $500,000 in her investment account. So we're not gonna renew her life insurance at
Not
all.
gonna do that one either, like,
Harold is male, right?
yeah.
Well, Harold is, as you see right here, it says class 6.
Mhm.
Men die before women, typically.
Oh, wow. That was obvious.
So if this was a female,
Uh-huh.
she would start at 4.
Yeah.
Start at 4. Yeah, but and so I got it. So she's actually going to be somewhere like this, 3 most likely.
Oh, yeah.
So instead of paying $95 a month, she's going to be paying $58.
Our insurance is cheaper.
Male is 95, female is 58.
That's the start.
So you can customize the coverage for what they really need, when they're going to need. And that's what I like to do.
Mhm.
Is instead of just put them all in one $500,000 policy for $148 a month, 30 years, they may not need that $500,000 for the whole 30 years.
You might not can go get another 500,000,
Right.
but you got a ceiling here that you guarantee this at this price.
Right.
You can always come down. That's the whole philosophy of
Right.
A.L. Williams, is buy term and invest in it.
Right.
That's right.
All our policies automatically for the first 10 years have what's called an IBR rider, increasing benefit rider.
Right over 10 years.
So what will happen is,
That
if I,
is included in that policy, is that price.
well, done.
Got it?
Okay, so here's the rest of the story. So let's say she gets a $500,000 policy today for 20 years. They issue the policy. They'll send her every year an option to increase her coverage by 10% and keep the at the same rate she paid when she was 48. Okay? For the first 5 years, right? Now, 5 years. So they'll send her a note 11 months from now. You have an option to go from 500,000 to 550,000. You want to take that option or don't you want to take the option?
At the old rate.
At the old rate. If she says no, they'll never offer to her again.
Okay.
If she says yes, then what they'll do is her coverage go from 500 to 550, and her premium will go up by a little bit. Okay? Next year they'll offer her that again. And if she ever says no, they never offer it again. Okay? There's a lot of times when you deal with a really young couple that are really living tight. I don't know if you've been there before, but I'll tell you,
God, yeah.
I know what it feels like. Okay, they're living tight, they can barely afford anything, right? And so at first, the husband really needs to have $1 million coverage. But he can't afford
Can't afford
$250,000.
it. Yeah,
Okay.
not first starting out.
So you write them $250,000 policy instead. But next year, they'll be offered to be able to increase it by $25,000 every year.
Just keep going up.
And they can afford $3 more a month premium. And then if you want to add a child rider on here, you can add a child rider. Now, let me tell you why I'm big on child riders. I unfortunately learned everything in my life the hard way. I wish it wasn't that way, but it is. When I first started, my very first death claim was a 9-year-old child. And I didn't like, prior to that, I didn't like putting life insurance on children. Because I thought, oh, you shouldn't do that. Well, because in my little brain, 9-year-old kids don't die.
Right.
Well, this 9-year-old child was in the hospital and died of pneumonia. I don't put $5,000 of coverage on that child because I put the minimum. Back then, that was the minimum.
Yeah.
Well, that pays for the funeral, barely. But you ain't going back to work the next day. Right? So now, and then nowadays, kids, when they go to college, they get student loans. And they're up to here in student loans when they graduate.
They come out, yeah.
Take care of that. Get that out of the way.
Well, but he's not here anymore. And so they're up to here in student loan debt, right? If like his daughter was going to college, and she was on her way back to college, right? And she was in a bad car accident, nearly died. If she had passed away, and let's say she had student loan, Jenny graduated. Let's say she had 20 grand in student loans. He lost his daughter, and now inherited $20,000 in student loan debt that will never pay for a college education. He still has to pay that. You can't die away from student loan debt. Now I understand why it's a better idea to do that. Especially, so matter of fact, I'll ask that question. How likely is it that you think your kids will go to college? They'll say, pretty likely. Everyone in our family's gone to college. We've all graduated. I'll mention that. I said, I want to put a larger amount of coverage on your children because there might be a chance you're going to use student loans. And you can't die away from student loan debt. So I want to make sure we have enough coverage on it. So what I do, I like to put, nowadays you can put up to $50,000 a student on child rider. I like to do 25. Okay, so that adds, I don't know, $13 a month. And that covers every child in the house up to 9 kids. But down the road, let's say his oldest child turns 25. When that child turns 25, or actually between the ages of 18 and 25, they're given the option to increasing that policy to 5 times their coverage without any proof of insurability. Okay, I had a case here in Griffin a couple of years ago where my client's 18-year-old son was on a motorcycle at night, okay, and ran into someone in the back of a van out on Rover Zotal Road. You remember what happened here about that? Yeah.
He ran into a van
Yeah, he
in the
ran
dark.
into a van going fast.
He didn't see the
Okay.
van? Good Lord.
It made him quadriplegic. Okay,
Oh my God,
So-
that was awful.
he was 18. You didn't get buying life insurance if you're quadriplegic. Because he had the coverage with me already, I was able to give him 5 times the coverage he had for 35 years without any medical questions. So that child has life insurance now for 35 years, and he's paying like $20 a month. He was already insured for 25. He was guaranteed 100. He guaranteed 5 times that, so he was guaranteed to 125,000
Okay,
without any proof of insurability.
125 is the max.
Yeah.
okay,
You could have 50,000, and we're not going to do 5 times that.
okay.
You're like a dude
125 is the.
Is the max, okay,
without proof of insurability.
oh, okay,
It's called a child conversion, child right conversion.
okay,
I get it. They send a thing to me every month of which one of my clients are turning 18 or turning 25
oh, okay,
that need to be looked at for child conversions.
okay,
And let's say I'm doing this quote, and I want to know what my pay is. So you see right here where you see the 3, they call it the hamburger here. You go down to where the agent information. It depends on where you are. As a rep, you get paid $158. Senior rep, district, division, $447. Regional leader, and then RVP. He's going to get 75% of this. So once the policy's been in the books for 12 months, then you'll get the difference. I'm not going to do business with a client with life insurance that they don't invest with me. Okay. So let's say the same client, I sat down with him and I said, ask some questions. When you do your taxes every year, when you go down to H&R Block and get your taxes done, how much of a tax refund do you normally get? And they say, oh, we typically get $3,000. So what I'll do, and I'll go through and find money more than that. Let's say that's all I find. So I said, we can adjust your allowances on your paycheck stuff, so you get all that money in your paycheck, and you don't get a tax refund this year.
get more going home.
So I'm going to get them to take that $250 a month and invest. So I'm going to go here. I get clients investing at least $500 a month on a regular basis. I got many clients investing over $10,000 a month. So, but let's say it's $250. Just a young couple getting started. So this young couple getting started, I'm going to put them in a mutual fund. I'm going to put them in a basic S&P 500 fund. A mutual fund. They call it S&P 500. The name of the fund is called the Invesco Equally Weighted S&P 500 Fund. So I'm gonna put them in this, they're gonna put $250 in here every month,
Mhm.
and they got a 30-year policy, right?
Mhm.
So in 30 years, where will they be? Okay, invest the difference. Okay, so we're gonna generate, so in taking that $250 a month, in 30 years, they're gonna have $1 million, $1,071,000 sitting in their investment account. So this is actual performance.
Everything goes like it has in the past, that's what you're basing that on, I guess.
Yeah.
And projecting that into the future.
Well, just showing them what it did. And which means I'm showing some really bad times. Okay. For example, 1987 was the year I became a stockbroker. The market went down 19% in one day. October, like Monday. Okay, I was a brand new broker when that happened. Okay, so you would have lost that year 5.5% of your money. 1990 was another down year. You lost 12.5%. We go down to 2001, 2002. It was down minus 2.26 and 15.68 that year.
Wow.
2008.
What year was that?
And then 2008.
House prices.
That's go down to 2008. So I'm showing you the good and the bad. Showing you everything that actually happened.
But taking the good with the bad,
Yeah.
over that time period, you have over $1 million.
And you average a 10.13% return. So now I got paid one time with the life insurance, right? But now I'm getting paid every month on that $250 that hits that investment account. And I'm being paid every year, every quarter, on what that account's worth. The more now that client's account's worth $1 million, I'm getting paid a residual off that $1 million forever. That's just one. I have 3,000. If I do nothing, I make
That's the only
30,000.
reason I'm sitting here.
Here, who won in this situation?
Everybody.
Me or the client?
Both of you.
Both. The client really won, yeah.
The client won because they don't need a $500,000 policy anymore. They got $1 million sitting in cash.
Yeah.
And here's the rest of the story. Rest of the story is, I guarantee you, I'm getting way more than $250 a month for the month. They wherever they worked, they rolled up. They worked at UPS, okay, and they had. How much money did you have? How much money does the average UPS driver have when they leave UPS?
Maybe, depending on which one you're talking about, maybe $100 grand by the time they leave. They should have more than that.
Yeah.
That's what I'm saying.
It should be way more than that.
Like million.
When I talk to, I have a lot of clients that are Delta clients.
Yeah.
They'll have at least $500,000.
You're in lose.
So,
Yeah.
so $500,000. Okay, then they're married. They have a spouse. They have money, and they're 401k.
Mhm.
So I'll end up with $1 million just on that part.
Yeah.
That pays me $6,200. Okay,
Yeah.
not counting the residuals on that.
Right.
Wow.
Then what happened to me this week is I've been doing that for this client. Well, their parents passed away, and he inherited another $2 million. So he invested that money with me.
Wow.
Okay, and now I put most of it in retail, part of it retail, part of it managed. Okay, so I'm getting part of it paid on that, and he'll retire with, he'll be getting 10 grand a month in retirement forever. Let's talk about how I ended up with a transmission guy that just invest. He's going to invest, but he'll invest between his corporate account, his personal account, 400 grand. He'll do a $3,000 a year premium loan. Okay, so I'll do that. But how did I end up with that client? How I ended up with that client is in 1994, I did business with a guy. He invested some money with me. He referred me to his son, who now has done business with me and has done over $3 million in investments with me. He's referred me to 3 other people that have done over $3 million in investments with me,
Okay.
and including this guy.
Okay.
Okay, so that one group has given me over $10 million in investments. He got another referral of another guy. He's now moved to Knoxville, Tennessee. He's got another guy that's got a $2 million house that he's paid cash for, that he wants to cash out the money and invest that money.
Wow.
That's mortgage business and
Securities.
security.
Yeah, so I'll get paid on a $2 million mortgage, 1%, that's 20,000. And if you take the 2 million, that's another 12,000. So I'll make $32,000 on that case.
That is
And
awesome.
I've never met the guy. I flew down to Cape Coral, Florida a week ago. That's why I wasn't here 2 Saturdays ago. I went down to see him and his wife. Because I like seeing people face to face. I like doing business face to face. So I sat down with them. And they're invested the 400 grand. Not counting, he just went from, he's going to invest way more money than that because he went making less than $100,000 a year. He bought the transmission shop. Now he's making over $500,000 a year.
A year with the transmission?
Yeah.
Oh, okay.
So he's going to be investing $20,000 or $30,000 a month with me.
Okay.
Okay, and because our goal is to have him, I'm going to have him at $2.5 million in 5 years. And then this other guy is refinanced the $800,000 house. He's also buying a $1.1 million house, but the one he was going to buy is now under contract in Florida.
Mhm.
So he's finding another one. But as soon as he finds that one, I'll be doing that one.
Okay.
That mortgage is in Florida also, so I'll get paid another $10,000, close to $10,000. Let's talk about the license. So I have a life and health license. Okay. I also have a full property and casualty license. You don't have to have that nowadays, but I have one.
Okay.
There was a point in Primerica where Primerica owned Travelers. We owned Travelers at one point, and we were selling auto and home policies. So anytime Primerica offers a new product, I get the license, okay? Because I want to get paid on as much stuff as I get paid on, okay? So I got my property and casualty license, which I thought was one of the hardest tests I've taken so far. Your license is insure boilers on ships. I mean, you're insured, your license covers a lot. Okay? So when you take the exam, you're answering questions about boilers on ships, okay?
Good Lord.
So you have to remember a lot of stuff. Property casualty license, okay, I have a securities license. I have a series 6, I have a series 7, but you'll have to have a series 6, which is mutual funds with the federal government, a 63, which was the state laws, 6 and 63 is securities license. But I also have the 65, which is a managed account license, which is the 6 is a commission license, where you get paid on commission. A 65 is you get paid on a fee-based license.
Mm-hmm.
I have that. And that's where the industry is going. The amount of money leaving mutual funds going to ETFs is stark. In 5 years, nearly no one is going to be in a mutual fund. The good news is 90+% of what's on the Series 6 and 63 is on the 65.
But before you do those, you gotta do the SIE. That's the extra 10
So,
that's going to.
Right. So, but the point is what, and I have a 60 and I have a 26. But
You said a 60 and a 26?
I have a 7, 63, 65, and a 26. But a 26 is I have to make sure y'all don't do anything.
Oh, that's comfortable.
If you do something wrong, you get a slap on the wrist, I go to jail. Now, let's talk about the Series 65. The problem I had is when I took these, I took my 63 and 7 in 1987.
Okay.
I didn't take my 26 until 1990 something. So it's been how many years later? 5, 6, 7, 8 years later. Okay. Then I didn't take my 65 until how many years ago? 5 years ago? 2012. Yeah.
Oh.
So it wasn't until 2012 I took my 65.
Mm-hmm.
Okay, so every time you take an exam, I take a brain dump. Yeah. I dump what I don't need anymore, right?
Yeah.
You don't need most of it. Because most of the stuff on the test you'll never look at
You'll
it.
never even see it.
The good news is if you study like what she's doing, one time, take a 6, 63, and 65, like all at the same time, you're basically taking the same test 3 times, and you're done. Mm-hmm. I also have a variable annuities license that I had to take a test. This is all on POL. Everything's on POL. How much they paid me last time, how to put investments together, how to put a mortgage quote together, an application, a life insurance quote, life out, you name it, it's on this software.
I could do your life app here, I could set up your IRA.
Everything I'm showing you how to do, you don't have to. If you come to class, you'll learn how to do it. He knows how to do it. Now, I'll tell you, I know I'm going to get farther in the weeds here, but the other thing I try to make everyone in this office learn how to use is the HP12C calculator. So this is the HP12C calculator. This is what I believe really helps me get what I need to get. Okay, so let's say I have a client, okay, $100,000, and what interest rate you making on your CD in the bank? 4%. How long is your CD going to be in place? 5 years. Let's say 5 years. Okay. 5 years.
It's just sitting in the bank.
So I'm just saying CD. I'm just using CD. $100,000 CD, 4% for 5 years. In 5 years, that that CD will be worth $121,665.29.
And you did no payments on that, right? No payments?
Yeah, I put 0 PMT.
Okay, 0 payments, okay.
So that's I have the floating rate fund that pays a 9.9% dividend. So instead of having $121,000 over the same period of time, all I do is plug in the interest rate, the different interest rate. You're going to have $161,000, $160. So you're going to have $40,000 more dollars in 5 years in your pocket if you put in the floating rate fund instead of a CD. We're told our money is insured by FDIC,
Right,
Federal Deposit Insurance Corporation.
right.
Everybody forgets of what happened in 1994.
What happened in 1994?
In 1994, there used to be a thing called savings and loans. Remember
Yeah,
those?
I remember those.
You see any more savings and loans around?
No, they disappeared.
Yeah, in 1994. Okay, so savings and loans used to be another way to save your money instead of a bank.
Right,
You deposit money in the savings and loan in the savings department, and it was insured by FSLIC, Federal Savings and Loan.
it's LIC, okay.
Yeah. Federal Savings and Loan Insurance Corporation. Yes, right.
Okay,
Okay, you deposit your 100 grand, and just like FDIC, you're told if you put 100 grand in the bank that you're insured, right?
right.
It's true, but here's the rest. As Paul Harvey said, here's the rest of the story. The rest of the story is, in the United States, there's only $8 backing every $100 in deposit. If your bank fails, they have 20 years to pay your money back to you,
20 years, okay.
and they're not paying any interest over that 20-year period. They're buying insurance to do that, okay? But here's the deal. They'll pay you a guaranteed 4%, because what they do is they take your 100 grand, they can loan 8 to 10 times what you have in a deposit. So let's say he puts 100 grand in his savings account,
Okay.
CD with me.
Okay,
I pay him 4%.
okay.
I can loan out $800,000 to somebody buying a house at 7.5% with his 100,000.
With his 100,000 making.
So I get
him.
8 times the money plus twice the interest. And I pay. That's why when you walk in a bank, you got marble floors, chandeliers, and
So
mahogany
that's so
desks.
nice.
You bought all
The
that.
money they're bringing in.
It's like when you go to Vegas, and you see the nice casinos with all the lights. Whose money is that? You want your money, like it says in the Bible, Ecclesiastes 11:2. King Solomon said, divide your portions into 7, no 8, for you do not know what disaster might come on the land.
Yeah, that
Means
is in the Bible.
diversify your money. Don't put all your money eggs in one basket. When you put your money in that floating rate fund, you're buying hundreds of bank loans, but it pays a 9.9% interest rate. So that money, that same 100 grand is going to be worth. You're going to have $40,000 more dollars in your pocket in 5 years by having it there than sitting in the bank. If you need this money, let's say you need 20 grand, or you need a new car. I can have the money back in your checking account in 2 days. Okay, so let's go back and learn how to do this calculation. Okay, so we're going to walk through it. 100,000. So I would put in the number 100,000.
Present value.
Okay, that's today, PV, present value. That's today's value, right?
Okay.
Present value. Click there. The money at the bank is what interest rate? 4. So I take 4 and I push I, because that stands for interest. Okay, how many years?
5 years.
5. So I get 5 and I plug it into N. N represents time. So I got 100,000, 4%, 5 years, right?
Mhm.
I'm not making any payments on it. I put 0 payments. I do want to know what the future value of that 100,000 is.
Okay.
So I push FV. Now it gives me a negative number because I change sign.
Okay.
So that 100 grand at 4% in 5 years is worth 121,665.29. A human being will trust a computer over another human being all day long. I don't know why it is, but that's the way it works. Kid the other day had $125,000 and he had in his account making 2%, and it'd been there for 7 years. I'm not sure, is that right, Cheryl?
I have 143,585.71.
Yes.
Good, okay. Now, let's say that the client says, you know, Eric, I want you to take that money. So I'm gonna take the 125,000
Okay.
and we're gonna do it simple. We'll do it simple again. I'm gonna get him a 10% return on it. It's gonna be there for at least 20 years. How much money is he gonna have? I always like that under promise and over deliver.
All right, we got our numbers the same, $840,937.49.
So what, now the guy says, you know what, Eric, I got an extra $200 a month I want to put with it.
Yeah, that's what, so let's do one more adding.
Okay, so let's say he says that. So now, but wait, since we're doing monthly, we're gonna make payments, right? So we gotta change some things.
Oh,
Okay, so it's there 20 years, right?
uh-huh.
So watch what I do. 20 blue G
Okay, 20 blue G.
N is 20 years
Okay.
because that's 200, makes it 240 months.
What's the blue G for? What is that?
It multiplies it by 12 because there's 12 months of the year. Since he's investing $200.
Oh, okay.
He's gonna get a 10% interest rate, right?
I'm already screwed it up.
No, but you can go back and fix it. What you-
It said a 0 for some reason, I don't know what
Okay,
it
all right, just put it in there.
You're not.
1, you can't mess it up. 10,
Percent rate,
blue
okay.
G, I divides the interest rate by 12. And we're gonna put $200 a month with it, that's the payment, and then we're gonna have the future value. So then we'd have
I'm
over $1
lost.
million.
Can we,
So it's 20 years,
But you,
blue G times 12 is how many months? Oh, it's 240.
oh, okay.
Okay, and then 10% interest annually divided by 12 is what? 0.83%.
Whenever you do months, you hit the blue G. Always hit the blue G for months.
That's the future value, right?
Uh-huh.
we're doing
1
1
million.
million first?
Yeah.
That you're doing the 1 million future
Because
value,
that's what he wants
okay.
to have in the future.
Yeah, right.
Right, he wants to have $1
Okay.
million in the future.
Okay.
Okay, he's got, and we still know it's 40 years,
40
40,
years, okay.
blue G,
And,
And-
time.
and we still know I can make him 12%, 12, blue G, I. He's got $0 in his pocket today,
0 payments.
and then I'll put 0 PMT just to clear it. And I'm gonna get what? How much money does he need to invest every month to hit that time?
$85, that tells you exactly how much he has to put in there.
$2.5 million in 5 years.
5 years.
Yeah. So that's the future
Future
value.
value is 2.5 million, okay, okay.
And he's got, how much money does he have today? 400,000. 400,000. Okay, now I gotta change the sign of that 400,000 because it has to be opposite of what the future value is. We need to change sign and I'm gonna average him a 10%
Okay.
return,
Return.
and he's gonna do it in how many years? 5 years. So how much money does he need to invest every month?
I got it.
23,785.
46.
So he'll, and by investing $25,000 a month, I'll have him over $2.5 million in 5 years. Okay, so let's do it again. Let's do the second calculation. $202,500,000. What is that? What is that number?
Future value,
That's my future value. So I'm gonna push FD.
Okay.
Okay, how many years is it gonna be until he wants that money?
5 years.
5 years. So since I'm finding out what the monthly payment is, I gotta do monthly. So I go 5, blue G,
Blue G.
N, that's time.
Uh-huh.
What interest rate am I'm gonna average him 10%.
10%
So 10,
Bougie.
blue G,
interest.
I.
Okay.
How much money do I have today in my pocket?
0.
No, I have 400,000.
400,000.
So I
Okay.
have 400,000, but since I'm taking my pocket to put in the account, that's gonna be a negative.
So CHS.
So I put that, that's my present money.
Uh-huh. So present value.
So I wanna find out how much money I have to add to the 400,000 to hit $2.5 million
In 5 years.
in 5 years. So it's 23,785.46. Now, here's what I do, as a rule of thumb. So let's say this. Let's say he has this 600, let's go back to 400,000. Let's say he has $400,000, $400,000,
Mm-hmm.
and he's gonna invest it,
Okay.
okay? And I'm gonna make him 10% a year,
Okay.
but he's gonna take out 5% a year. He's gonna take $20,000 a year to make the payments on the house he bought.
Okay.
So he's making 10, but 5 of it's gonna go back to the house payment. The other 5 is gonna make money.
Okay.
So not only does he have the money to make the payment with the house, let's say he's paying 7% interest rate,
Okay.
okay? They're gonna take 7% of the money from the 400,000.
Mm-hmm.
He's still making 3,
Okay.
right? So we're gonna take 3 and put it on there,
3 interest.
and we're still gonna have it there, let's say, for 10 years.
10 years. Okay.
And no payments.
0 payments.
What's he gonna have? Well, he still has $137,000 more than he started off with.
Yeah, he's got 537, 566. Is
He
that
put,
with
he
him?
put 400 grand in. He's taking out 7% a year to make the house payment.
I understand.
He still has $137,000 more than he started off with, even though he's been taking out what's
So basically.
$3,000 a month out for 10. He's taking out $350,000. He's taking out $350,000 over that 10-year period, and he still has more money than he's paying.
Basically, you just say it was.
Now, if he dies, what does his family get? House or money?
Money.
Both. House and money.
Okay.
See, before, he owned that house outright. He owned that 400,000 outright, right? He would have passed away, his family would inherit a $400,000 house, right?
Right.
Okay, who wants to inherit their grandfather's $400,000 house?
Nobody.
Nobody,
They'll sell it.
okay? Because they're gonna sell it. So what would most people rather inherit, money or a house?
Money.
Money. Okay, money gives you options.
Yeah, money.
Okay, so they inherit, so now he did this 10 years ago. They don't inherit $400,000 now. They inherit $537,000 plus a house that's been paid on for 10 years. So they get some money out of that too.
Yeah, they'll still.
So they get the 537 plus part of the money from the house.
It's very interesting.
It is.
That's why I don't like paying off houses.
Explain what.
That's why I won't pay off my house. I could have paid my house off a long time ago. Not doing it.
Saw Robert Kiyosaki quote on Facebook this week. He said, "Debt free is stupid."
Debt free is stupid.
Well, because your
And
money,
that's the way we was raised to think.
that's why we are all poor.
Wow, I just listened to you say
We're
that.
poor because we were taught how to be poor.
Wow.
Remember that?
And we're good at
Where
it.
did you see, where did you see that phrase?
I get so
Robert
Kiyosaki.
Robert Kiyosaki, he wrote Rich Dad Poor Dad.
Oh, that guy, okay.
Great, really,
Yeah,
and his book, Cash Flow Quadrant, even better.
Yeah.
Right kind of deal. And Dana Andrews was an actor who got out of acting and went into real estate. I saw him on a talk show toward the end of his life, and he made himself very rich. And he said, "You know how I made myself so rich? Opium." And he said, "Opium," said, "No, OPM, other people's money."
And using other people's money.
Yeah.
You borrow somebody's money, they're willing to loan it to me at 4%, and I can make 10%. Why would I not take their money? They give me a 4
And
and make 10 on
And keep 6.
it, and keep 6.
Wow.
Why would I not do that?
I'm being stupid because of lack of knowledge.
Right.
Yeah.
And that's okay.
People
What you're
can
hitting.
make an intelligent decision if they're given all the facts.
Right.
Yeah.
And that's what my job is. That's what
It's all the options.
our job. And I tell my clients when I first sit down with them, my job is not to say anything. My job is to teach you something. I'm going to teach you how you should be doing your money. I'm going to teach you how to do it. Now, you might choose not to listen to me. That's your choice.
Yeah.
Okay. But if you listen to me, you will make money.
Okay.
Okay. I'm going to teach you how to do it. And some things I'm going to tell you are going to sound like blasphemy.
That's right.
You're going to be told things that you're going to think are wrong.
Wrong, yeah.
Such as putting a mortgage on a $400,000 house you already own. You would think that sounds bad.
Yeah, real bad. They'll like look at you like, are you crazy?
Yes,
It's
they
paid
will.
for it.
Yeah, but that $400,000 sitting in that house making no interest. How much interest does that $400,000 that house make?
Zero. It's just sitting there.
0. And you still have to paint it, pay taxes on it, mow
it
around it, all the things you got to do to it. You got to
Yeah.
put a roof on it, water heaters, all this stuff goes with it.
Yeah,
So you still have all those expenses with it.
yeah.
And that $400,000 is making $0.
People who worship having a paid off house. And
And
I tell them,
I built my
I
house.
can't eat the house.
Built my house in
That's
2006.
yeah, because you
I-
people, oh, my mortgage paid for, I'm debt free,
I
oh, my mortgage.
I have a minimum payment. I have a 3.5% interest rate on my mortgage. I just pay the payment every month. And I'd rather, because I'm putting chunks of money in my investment account instead. That would be sitting in the house.
Eric and I sat with a lady, retired woman, who her husband had died. She got a nice insurance settlement. We sat with her and her daughter and son-in-law. And that son-in-law was so angry with us, he was trembling.
It made him that upset.
He was furious. You would advise a 70-year-old woman not to pay off her house? And exactly what we advised, because you can't eat the house. He didn't exactly throw us out, but it was pretty close.
You can't buy groceries. You can't buy groceries with that money sitting in the house.
That's exactly right.